Chasers! Withdrawing part of your superannuation fund balance, then paying it back into the account, known as a recontribution strategy, may sound a little strange, but it could deliver a number of benefits, including reducing tax and helping to manage superannuation balances between you and your spouse. Today's episode is about using your superannuation balance and the rules regarding contributions to tax effectively set up the non-tax dependent adult children of your family if you pass away. I'm your host, Chris Becks, a financial and business advisor with over 40 years experience and the founder of the multi-award-winning CBEX Business Solutions for Good. And because this is a financial planning topic, as an authorised representative of Interprac Financial Limited, I'm obliged to give you this general advice disclaimer before we begin.
The information provided is for educational purposes and is general advice only, as we did not take into account your investment objectives, financial situation or particular needs. Before making an investment decision on the basis of this advice, you should consider how appropriate the advice is to your particular investment needs and objectives. You should also consider the relevant product disclosure statement before making any decision relating to a financial product. Chris Becks is a director of CBEX Financial Solutions and an authorised representative of Interprac Financial Planning Proprietary Limited, AFSL 246638.
Okay, now that is done, let's dive into this episode. Your super is made up of tax-free and taxable components. The tax-free part generally consists of contributions on which you have already paid tax, such as your non-concessional contributions. When this component is withdrawn or paid to an eligible beneficiary, there's no tax payable. The taxable component generally consists of your concessional contributions, such as any salary sacrifice contributions or the superannuation guarantee contributions your employers have made on your behalf. You may need to pay tax on your taxable contributions depending on your age when you withdraw it, or if you leave it to a beneficiary who the tax laws consider is a non-tax dependent. How recontribution strategies work. The main reason for implementing a recontribution strategy is to reduce the taxable component of your super and increase the tax-free component. To do this, you withdraw a lump sum from your super account and pay any required tax on the withdrawal. You then recontribute the money back into your account as a non-concessional contribution. If you withdraw this money from your account at a later date, you don't pay any tax on it as your contribution was made from after-tax money. The recontribution doesn't necessarily have to be into your own super account. It can be contributed into your spouse's super account, provided they meet the contribution rules. To use a recontribution strategy, you must be eligible to both withdraw a lump sum and recontribute the money into your super account. In most cases, this means you must be aged between 59 to 74 and retired or have met a condition of release under the super rules. Any recontribution into your account is still subject to the current contribution rules, your total super balance, and the annual contribution caps. So what are the benefits for your non-tax dependents? Recontributing your money into your super account may have valuable benefits when your super death benefit is paid to your beneficiaries. A recontribution strategy is particularly important if the beneficiaries you have nominated to receive your death benefit are considered non-dependents for tax purposes. the definition of a dependent is different for super and different for tax purposes. Recontribution strategies can be very helpful for estate planning, particularly if you intend to leave part of your super death benefit to someone who the tax laws considers a non-tax dependent, such as an adult child. Otherwise, when the taxable component is paid to them, they will pay a significant amount of the death benefit in tax. Your spouse or any dependents aged under 18 are not required to pay tax on the payment. Some non-tax dependents face a tax rate of 32%, including the Medicare levy, on a super death benefit. So, a strategy to reduce the amount liable for this tax rate can be worthwhile. By implementing a recontribution strategy to reduce the taxable component of your super benefit, you may be able to decrease or even eliminate the tax your non-tax dependent beneficiaries are required to pay. Our retirement system has lots of complex tax and super rules governing how much you can put into super and when and how much you can withdraw. Before you start a recontribution strategy, you need to check you will meet the eligibility rules both to withdraw the money and contribute it back into your super account. A recontribution strategy where part of your super fund balance is withdrawn and then paid back into the super account could deliver a number of benefits, including reducing tax for non-tax dependents and help manage super balances between you and your spouse. As with any financial planning or matters relating to tax, to ensure a smooth transition and make informed decisions, always get some advice from an expert before you do anything. It's good insurance against costly financial mistakes. If you would like more information about how a recontribution strategy could help your non-tax dependents save tax, give our office a call on 55 612 643 today to discuss your options. Thank you for listening. I'm Chris Becks, and I look forward to presenting another episode to you real soon.
If you enjoyed this episode and you'd like to help support the Chasers channel, we would love you to share it with your business friends and colleagues, post about it on social media, or leave a rating and review. To catch all the latest from CBEX Business Solutions for Good, follow us on Facebook at facebook.com/CBEX, Instagram at CBEX, and on the internet at cbex.com. Thanks again, and we'll be sharing new info with you on our next episode.